On today's episode, we are going to take a look at FSLY, ticker FSLY. They just reported earnings and they are down big. So in today's episode, I'm going to break it down into a few sections. The first section, we're going to take a look at pretty much all the major points from their earnings. We're going to take a look at the future growth this company is expected to make. And then later on, we're going to do a little more in-depth analysis and take a look at those numbers in their balance sheets and their cash flows and see what's really scary about this company, or if there is anything scary. And finally, at the end of the episode, I am going to talk about my thoughts on the company. If I'm debating on buying, if I'm debating on selling, on holding, what am I thinking about FSLY? And like always, guys, if you are new to my channel, if you are a long-term investor, and if you like to learn about growth stocks, make sure to hit that subscribe button. And to all my returning viewers, thank you all for the support. I truly appreciate it. Make sure to always hit the thumbs up. It helps the small channel out so much. If you guys ever want to get in contact with me, make sure to post on the YouTube comments. I also have a very active Twitter for all my podcast listeners, and I do have a Discord channel which is free to anybody, and a weekly newsletter at josenaharo.com. But remember, all of this information is free. None of this is advice. I am by no means a professional, so make sure to talk to a financial advisor before making any investments. All of this is just my opinions. All right, so like I mentioned, right, FSLY was down 6% for the day before reporting earnings, and after hours is down another 14.5%. And this is pretty crazy, right? This is I kind of been sounding like a broken record in my most videos. I've been saying that I've been a little worried about the clouding stocks ever since Amazon reported earnings. And we might be like, what does Amazon have to do with FSLY? Amazon, if you guys took a look at that video, I mentioned how one of the major parts of Amazon that did not meet expectations was AWS. Their e-commerce destroyed it, but AWS, which is their clouding department, did not beat expectations. So that told me that analysts were a little too over bullish on clouding companies, and right now we're seeing that with Twilio, we're seeing it with FSLY. So that's a great thing about looking at earnings in other companies. It can kind of give some form of foresight of how things converge, right? It doesn't mean you're gonna always be 100% right, but I do believe it increases your chances of understanding how the market is doing. And before we go any further, take a listen to today's sponsor by 7 Investing. Today's episode is sponsored by my friends at 7 Investing, where every month they provide their top 7 stock market recommendations for only $17 a month. They already provided their August recommendations, so make sure to click on the link below. You can find it on the description or in the pinned comment for more information on this great team. Alright, so FSLY, not counting today's after hours drop, has a market cap of about $11 billion. So remove that 14%. This would give it tomorrow a market cap close to high 9s, very low $10 billion. So today we're going to see, is that valuation understandable right now, or is it a valuation that might have been a little too ahead of itself? All right, so let's take a look at their earnings results. So FSLY, they did beat the non-GAAP earnings per share, which were 2 cents, and it beat by 3 cents. They did report GAAP earnings per share of negative 14 cents, and this missed expectations by 7 cents. And here we can see, based on their GAAP earnings per share, that right now this is a company that is not making any money at the moment. Revenue for this company was $75 million, only $75 million, and that was up 62% compared to a year ago, and it did beat expectations by about $3 million. So we can see this is definitely one of the smaller companies we normally take a look at. Let's just assume that revenue is on a 4-quarter basis. This company makes roughly about $280 million. So this has a very big price to sales ratio at the moment, to say the least. They did mention that total customer counts increased to 1,951, and this is up from 1,837 in Q1 of 2020, and this has been their largest quarterly growth since IPO. So we can see they got about 120 new customers this quarter alone. One of the biggest news that they did mention was that that TikTok is one of their largest customers. This is accounting for 12% of the revenue this past quarter. And I can understand why something like this would cause the stock price to drop down, especially with all the uncertainties happening with TikTok, right? With supposed talks of banning TikTok. If TikTok gets banned, it will reduce the amount of service that it needs from Fastly, therefore reducing the amount of revenue. And for one company being over 12%, of the company's total revenue means that it would take a big hit. So I do believe this is one of the major reasons this company is down. I do believe there are other reasons that I'm going to discuss later on, but I do think this is the one that really, really takes it over the edge. All right, so next I want to take a look at historical growth that Fastly has seen in the past. So remember, this quarter, Fastly grew about 62% in revenue compared to the same time last year. In the previous quarter, it grew 38% year over year. In the quarter before that, it grew 44%. And the one before that, it grew 35%. So we can see Fastly has maintained a very healthy growth of over double digits, always being above 30%. And that to me tells me that Fastly is a very, very strong growth company. And we can see this quarter alone did way better than most. The previous best quarter was 2 quarters ago, where it grew about 44% year over year. This quarter, it grew 62% year over year. Another thing I wanted to take a look at is pretty much this company's historical gross margins and profit margins. Most of the past quarters, this company has had a similar gross margins of about 56%. You can see throughout this chart that it has increased a little bit as time progresses. But one thing we don't see much improvement is in this company's profit margins. In the previous quarter, the trailing 12 months profit margins were about negative 24%. So we can see this company is still losing money. The thing that is important that we're going to have to take a look at later on is, one, does it have a healthy balance sheet to be able to survive losing money for the next few quarters? 2, how much cash flow is burning during this time? And mixing that with the balance sheet, it can help us see, hey, yes, this company will have enough cash to survive for some time. Next, what I want to take a look is analyst expectation growth for Fastly. The first thing I want to see is the revenue growth. So for the next 3 years, Fastly is expected to grow 24% annually on average. This doesn't mean that every year will go 24%, but for the next 3% on average, the annual growth will be 24%. This is way higher than the industry, which is 12.2%, and this is way higher than the market, which is 9.4%. When you have a revenue growth of over 20%, many people consider that a growth stock. So we can see Fastly is still going to be a growth stock for the next 3 years. Unfortunately, earnings are not going to be growing at that same rate. Earnings are expected to grow only 8.3% for the next 3 years on annual. So again, that does that mean every year they're going to go 8.3%. Some years might be more, some years might be less, but for the next 3 years, that will be the average. This is way below the industry, which is expected to grow 24.7% on average per year, and the market, which is expected to be 22.6%. Another thing is Fastly for the next 3 years is still expected to remain unprofitable. And that's a little scary, right? We can see estimations for December 30th of 2022. This company is expected to make somewhere around $500 million in revenue, but still lose about $43 million a year on that. So we can see this is, at the moment, analysts do not expect this to be a profitable company anytime soon. Full disclosure though, right now there's only about three analysts following the company, so this can change as more analysts begin to follow Fastly. A few things that I didn't think I was gonna mention in today's episode, but I think this is pretty cool. In their most, whenever this was updated, which was probably about a quarter ago, individual insiders owned about 16% of the company. And Arthur Bergman, who is the chairman of the board and is also the co-founder, is the biggest holder of FSLY. He owns about 10% of the company alone, and that to me is pretty impressive. That alone is it's a very, very bullish sentiment. All right, so next what we're going to take a look at is their shareholder letter. And no, don't worry guys, we're not going to take a look at the full letter. I've highlighted all the all the information that I found pretty useful. So here in the shareholder letter, the first point we're going to take a look at are just some of the highlights. The first thing is, remember how I mentioned that this company grew total customer counts to about 1,951, and that's up from 1,837. Remember, this is definitely a small company, right? Customers of less than 2,000 definitely speaks volume that this is still a very, very small company. Out of that 1,951 customers, 304 are big enterprise customers, and that's up from 297 a quarter ago. So they grew about, what's that, seven new enterprise customers. That's the type of growth they saw in one quarter. So this is another reason I believe the stock price has gone down, is seeing that kind of growth in big enterprise customers is very, I want to say, very unsatisfying. I would love to see more enterprise customers, especially because of the following point. Enterprise customers generate 88% of the trailing 12 months total revenue, consistent with Q1 of 2020. So right out of that 300, they have over 1,951 customers. 304 of those customers make up 88% of total revenue, and that only went on, that customer count only went up about 7 compared to same time last quarter. So we can see this is definitely one of the, I want to say, another thing that led customers to seeing something that they might have expected bigger growth, so it did not meet investors' expectations. GAAP gross margins were about 60% for the quarter, and this was up from 55% of Q2 of 2019. So they are getting better with their margins, which is a great thing. And that normally tends to happen with software stocks or anything with a software as a service basis. Or once they have the main product and once they keep increasing their revenues, that gross margins also increases because the overall total cost of that product is not going to increase. Right now, this company is, like I mentioned, is losing about $14 million a quarter. That's what it lost this quarter compared to $12 million a year ago, right? That does not seem like a lot of money. And then we're gonna take a look at how much money they're burning from their cash flow. One great news to investor is that they are raising their full year guidance for 2020. All right, and this to me was a little weird. I guess because of contracts, they can't really disclose any names right now. But here they mentioned 3 highlights of 3 big customers that enter them. First, as well as wellness at home becomes more prominent. So right now we're seeing a lot of more mobile applications kind of helping people out working out from home. They have seen customers built in a customer from their wellness at home mobile application join FSLY. They have seen a streaming at home leading European broadcast solution choose FSLY for their products, and again, and also an online gaming developer for MMO online games has also chosen FSLY to optimize and accelerate the in-game assets and interactive to over 75 million of their browsers and mobile casual game customers. So we can see there are, and the great thing about this is showing the types of markets that FSLY can grab. The next thing I want to take a look at is their expenses. Their expenses have gone up. And again, right, numerically wise, this is one of the a smaller company than we normally see. This quarter, they spent about $17 million in research and development, and this is up compared to $11 million same time last year. So they are spending more money. The main reason is they increased their employee count, and they've also increased the equipment they're using for new products and new features that they're gonna work on in the future. They've also increased their sales and marketing expenses, and these are two expenses that I am happy to see go up. Many people don't like expenses going up, but these are two that I like to see go up. Research and development, make sure the company is always up to date with its technology. Sales and marketing is making sure that their product is known outside. So sales and marketing expenses are 25 million, and they're up from 17 million same time last year. Same reasons, right? They have increased headcount, personnel, and they're using more methods for marketing. All right, so next, we're gonna take a quick look at their balance sheet in a bit. But here, I want to show you guys that they do mention that in their cash flow statement, they only used about $9 million in the quarter for operations. So for their everyday activities, they've only burned through $9 million. And remember, any company that's burning, this is a growth company. So normally growth companies, you tend to see that they are burning money at the beginning because right now they're just trying to acquire customers. The thing that really is important with growth stocks is you have to make sure that they're not burning faster than what they have in their bank account. And that's what we're going to take a look at. So remember that $9 million burn. Next thing we want to show is they did increase their full year guidance for the year. Previously, they were expected to make somewhere around 280 to 290 million. Now they're expected to make 290 to 300 million dollars. All right, so next what I want to do is I want to take a look at this company's balance sheet. And let me see if I can zoom in for you guys a little bit. I don't think it really helps out right now. But the first thing I see is their total current assets has increased dramatically compared to December 31st of 2019, which was about 6 months ago, which was their end of their 2019 fiscal year. So we can see total current assets 6 months ago were about 250 million. Now they're 525 million. So you might be like, Jose, wow, they're doing a lot better. They have a lot more cash and cash equivalents. And yes, that's true. 6 months ago, they had about $16 million of cash. Now they have over $257 million of cash. And they have about $126 million of marketable securities, which is probably similar levels to about 6 months ago. So we can see their overall cash increased by about 250 million, and that's what pretty much drove this total current assets to go up. Next, their total assets went up by very similar value, mainly due to that increase in cash and cash equivalents. So their total assets right now are sitting at about $600 million compared to $320 million 6 months ago. So now that we see their total assets have increased a lot, there's only two ways they could really have increased that amount of cash. It can't be through revenue, right? Because through revenue, they've only made about $70 million this year in revenue, this quarter in revenue. So it's definitely not by that. The only two things that can happen is one, they either took out a new debt, some new loans, or two, they ended up doing some offering where they ended up doing some more shares and liquidizing some more shares and getting money through there. We can see that their total liabilities compared to 6 months ago have not changed by much. 6 months ago they were 63 million, now they're 65 million. So we can see they did not increase that cash through a long-term debt. So that to me is okay news, but that only means one more thing. And we'll look at that in the cash flow statement. We can find that information in the cash flow statement in a bit. What I do want to say right now is this company has plenty of cash and cash equivalents to pay off its total debt, which is great news. So that means this company definitely has enough money to burn. We saw in their cash flow before that they were burning about $9 million per quarter. So let's say in a year that's about a little over 35. Would it be 35 million? So let's say accumulate 40 million burn rate per year. So this company has enough money to survive at least 5 years, maybe even 6, without ever making a dime. And that's just the strength of this. So it shows that this company has a very strong balance sheet right now. And now let's take a look at their cash flow. Here's the net cash used in operations, which was about $8.7 million. And here is the information that we did. Net cash flow provided by financial activities. They did a proceeds from following up a public offering. So in a public offering, they increased about $275 million in cash. That's where most of that cash comes from the balance sheet. Again, it's not a bad thing to build up cash, but remember at the same time this is diluting shares. So it's bad and good things. Now this company definitely has enough cash to survive like I mentioned, about 4 to 5 years without making a dime if it continues with the similar burn rate as it has now. All right, so I think that's all the information that I had on Fastly. Let me actually let me give my opinions on Fastly at the moment. So right now, Fastly does seem like a great company. It's definitely a company that we're seeing strong growth, and we're seeing a product that seems to be needed by many different genres. Only though this company also has very strong cash, it's seeing strong revenue growth. It has strong balance sheet, and it's not burning as fast as many anticipated would. What I do not like is we only saw a very small increase in enterprise businesses. And remember, enterprise businesses make up 88% of the trailing 12 months revenue. That's a big portion. So the only thing, as this gets bigger and as it gets more enterprise, most of that is reoccurring revenue. So that's always the great thing about SaaS styles revenue, reoccurring revenue type companies, where they once they accumulate the customer, it's very hard for the customer, not very hard, but the customer usually does not leave and they stay within the company. But yeah, it does seem like it's not growing as fast as people anticipated, mainly because of that enterprise. That news based on TikTok was also something to continue to drop this down. At the moment, Fastly is one that I'm not gonna mind buying more into. Again, if you guys are new to my channel, I dollar cost average almost every of my positions. So it's not like I go and buy a big position at once. It always depends on the type of investor you are. For me, I dollar cost average every week. I put a few $600, $400, $500 in my account per week, and I divide that amongst different shares. Fastly is one I am definitely going to keep adding onto little bit by little and adding to this position. I think after this nice sell-off, it definitely gives a nice buying opportunity. Regardless, Fastly has been a double bagger for me already. It's been a double bagger for me. So my price point is bought off really low. So I'm gonna mess up that original price point for my stock, and I don't mind. This company does seem like it's gonna continue to grow, and it does seem like it's in a product that right now has the moment to accelerate due to the overall market. So I hope you guys enjoyed today's episode. Like always, make sure to hit the thumbs up. Take care, guys. Have a good night, and see you next time.